All right, everybody. Welcome to today's webinar. My name is Jerry D'Ambrosio. Hope everybody's doing well. Today's webinar is called 3 Techniques to Help You Capture Trades of a Lifetime. Do want to do a quick sound check just to make sure everybody can hear me okay and can see my screen. If you guys don't mind using the chat box to let me know that you're here, that you see my screen, and that you guys are ready to go. There we go. Kingsley says yes and yes. All right, if Kingsley can hear me, I'm sure everybody can. Pamela says yes, fantastic. I do want to say, guys, that I do have Ray Clark in the background. Ray will be answering any questions that you guys have along the way. We're going to spend about an hour together. I have a ton of content to cover. If I look over and I think that there's a question that's really relevant to what I'm talking about at the time, I'll go ahead and answer it. I'll repeat it, of course, and then answer it. But if you have any questions, please ask, because Ray will be here in the background answering questions along the way. And it's great to see a lot of friendly names of people who come to our weekly coaching. So I want to thank everybody for joining me here today. My big promise to you is that by learning what I'll show you today, you'll see how you can use technical indicators to help anticipate what is likely to happen in the future. And I really want to emphasize that word anticipate, because technical analysis nor I predicts anything. We're not about predicting. It's about taking a look at these indicators, and really what they do is they just help us get an idea of what is likely to happen moving forward based on what's happened historically, using some of these indicators. What I want you to understand, one of the main things I want you to take away from today, is that speed is the key. The speed at which you find your trades and react. All right. I've got a lot to cover today. If I show you, as I show you the technique, if there's a tool that I use to help me, I'll show you that tool as well. And at the end, I'll show you a way to get the tool if you want it. Now, the people that I've worked with over the years, they let me know some of the issues that they have. By the way, if you guys stick with me to the end, remember, we're going to be together for about an hour. I'm going to share with you a copy of today's slides. So what I want somebody to do right around 2:50 or so, just say, hey, Jerry, don't forget the slides. What I'll do is I'll put them in the handout section of the GoToMeeting control panel. Okay? But somebody remind me, because I do sometimes forget. I got a lot of content to cover. So again, the people that I've worked with over the years, they let me know some of the issues that they have, excuse me, when it comes to finding trades and just using technical indicators in general for trading. They feel like it's a crapshoot. It's been a great run off of the March low, but the market's still a little volatile. Bigger upswings, bigger downswings. You really have to follow the trend for sure. But they just feel like it's a crapshoot when it comes to trading in general. They also feel like they don't have all the knowledge. They feel like they don't know everything when it comes to trading. And we're talking trading here, guys. We're not talking about investing. Big difference. Big difference in your holding period, big difference in your analysis. So we're talking trading here. So when it comes to short-term trading, swing trading, using technical analysis, they just don't feel like they know everything. So they avoid it. They say, you know what, there's too many indicators. They got all these funky names. So they say, I'm just going to stick with what I know. I'm going to stick with my core fundamental valuation, focusing on earnings and sales growth and earnings growth and valuation, things like that. Plus, when they do it, when they start to dive into technical analysis a little bit, they spend hundreds hours and hours a day looking at hundreds and hundreds of charts. I've spoken to people who go through hundreds of graphs in a day, sometimes not finding any trades. You can imagine if you do that for too long, you're just going to really wind up frustrating, pulling your hair out. You're going to give up. You're not going to want to really actively trade anymore. But what we want to do is just put probability on our side. You don't want it to be a crapshoot anymore. You want to stack the deck in your favor. You want to know what you're doing. Well, you might not know everything about everything. There are dozens and dozens and dozens of technical indicators and, you know, the same, dozens of chart patterns. There are so many things to learn when it comes to swing trading and technical analysis and chart patterns and things like that. You don't have to learn it all. You want to, just know exactly what you're doing. You need to know to be successful. And plus, you want to find your trades quickly, right? Instead of looking at hundreds and hundreds of graphs every single day. Now, the thing I discovered is that there are 3 areas that traders need to focus on to be successful. The first is when. Excuse me. There are different types of market situations, and you need to know when to use certain indicators. Granted, there will be special situations and times where you might mix and match. I'll talk about that a little later. But we will talk about the main ones. And you need to know what types of markets there are and how to identify each market so you know what indicators to use. Next is what. What are the indicators? Granted, again, there are dozens of technical indicators out there, but if you could focus on a few at first, it will help you tremendously. And then finally is how. How am I going to find my trades? Understanding what the market is doing is first and foremost. Once you recognize what the market's doing, the next rung on the ladder is what indicator is ideally suited for that market situation. And then once you know that, it's all right. How am I going to find trades? How am I going to find my trades? Now, there is the one-by-one method where you look at charts. And I don't mind looking at charts. I'd rather a faster way to do it. Let me say it this way. I'd rather a faster way to get most of the way there, meaning I'll run a scan to filter through stocks that meet certain criteria, and then I'll look at the charts. I'm not just going to go look at 500 graphs right out of the gate to find crossovers or breakouts or things like that. I'm going to use a breakout or a crossover search, and then I'm going to look at the charts. All right, so there are some faster ways to do it. What's been the most difficult part for you about finding stocks to trade? And I'll give you guys a few seconds to answer this question. Think about it. What's been the most difficult part for you about finding stocks to trade? Not once you're in them, because I know what the answer is going to be if I ask what's the most difficult part after you buy a stock. The answer is going to be when do I get out, right? But that's not what I'm asking. I'm asking what's been the most difficult part for you about finding stocks to trade? And I'll give you guys a few seconds to answer. Nobody has any difficulties when it comes to there we go. Okay. So comment here. Some indicators say buy, others don't. Gotcha. I believe that has a lot to do with just the indicator itself, because there are oscillators, there are trend change indicators. So there are different types of indicators that will just inherently tell you different things. So while an oscillator, for example, while stochastics might give you a buy signal, the MACD won't, because of the nature of the indicator itself. So and that's good that you say that, because we're going to talk about different indicators and faster indicators, slower indicators, right? Lagging indicators and more and quicker indicators. So the first thing you need to know is when to use the indicators. So here we're going to talk about market environment. There are 3 main types of market situations that we need to talk about. The market can do one of 3 things. It can trend. We all love this market, right? Nice trending market. Higher highs, higher lows. Traders love it. Investors love it. Everybody enjoys a nice uptrending market. Then there are situations where it doesn't trend anymore. It kind of moves sideways. It trades in a channel. It's otherwise known as a trader's market. Investors don't like this type of market. A sideways market for a buy and hold investor is not fun. You don't really make much money, generally speaking, right? The average stock in a sideways market is doing that, is moving sideways. But traders like this type of market. They welcome sideways moving markets that essentially bounce up and down, back and forth between support and resistance. They'll play it both ways. And then finally, the market can hit an extremely oversold situation, very similar to the one that we're almost in June now. So the end of March, right, was the bottom. We're a little more than 2 months now off of the bottom. But in March was a situation that I'm talking about here, an extremely oversold situation. December of 2018, very similar situation. So here's what a trending market looks like. What we're looking at here, guys, is what's called the VectorVest composite. The price chart that you're looking at here is called the VectorVest composite. We track around 8,000 stocks in our database, and we use this VVC. It's called the VVC. It's an average of all 8,000 stocks. We use it as kind of the foundation of our market analysis, of our trend analysis. You can think of it the same as the S&P or the Dow or the NASDAQ or the Russell. It's a broad market index, but it's our broad market index. All right? So here, this was 2017. I'm going to move from left to right. We're looking at 2017. Nice uptrending market, right? Market hits higher highs, higher lows, not a ton of volatility. What our jobs are as traders is to take advantage and to buy stocks, either new stocks or add to your existing long positions after each subsequent high or low. Okay? So in an uptrending market, we want to be bullish only. We don't want to be bearish. We don't want to take on bearish positions. We want to get defensive after each higher high and subsequent pullback. Defensive means tighten up your stops, take profits, right? But we don't want to short stocks. Why don't we want to short stocks? Why don't we want to open short positions after each higher high and subsequent pullback in an uptrending market? The simple answer to that question is because, generally speaking, those pullbacks are short-lived. They're short-lived because you're in an uptrend, right? You wouldn't be in an uptrend if the pullbacks weren't short-lived, right? You'd be more of in a downtrend or a sideways market, but you're in an uptrend. The rallies are longer. The pullbacks are, generally speaking, shorter-lived. So we want to be bullish only in an uptrending market. Okay? So that's how you recognize a trending market. Higher highs and higher lows. Now this is 2018. So what we're looking at here is the entire year of 2017. Now we're into 2018. And the market is no longer trending. Now this is January to August of 2018, most of the year, 8 months. How do I know that it's not trending anymore? Okay, well, it's not hitting higher highs anymore. But it's not hitting lower lows either. Right? If it wasn't hitting higher highs, and by definition, if it's not hitting higher highs, you might be hitting lower highs. And if the market was hitting lower highs and lower lows, what type of market would you be in? You'd be in a downtrending market, right? But we're hitting lower highs, but we're not hitting lower lows. So essentially, the market's just moving sideways, bouncing back and forth between support and resistance. Again, this is an investor's nightmare. If you're a buy and hold investor, you make money, you give it back. Same stock. You make money, you give it back. Same stock. Make money, give it back. You're buying and holding because that's the plan, right? You're a value investor, you're a position trader, you're a longer term investor. You're not a trader. So you're theoretically not making any money here. Traders, though, they love it. They buy at support. They sell at resistance. They buy at support. They short at resistance. They're playing the market back and forth as it develops, making money on both sides. Then, now we're looking at 2018 here, the end of 2018. And the market at the end of 2018 hit an extremely oversold level. Now, how do I know that? Within the VectorVest program, we have two indicators that help us identify oversold market situations. Those indicators are the MTI and the buy to sell ratio. When the MTI goes below 0.60, it's on a 0 to 2 scale. When it goes below 0.60 and or the buy to sell ratio goes below 0.20, now the buy to sell ratio is not on a 0 to 2 scale. It's just a simple ratio of buy rated stocks to sell rated stocks in our program. In other words, if there are more buys than sell, if there are more buy rated stocks than sell rated stocks in our program, the buy to sell ratio would be above 1. It's a ratio of buys to sells. The indicator would be above 1. It can go to 2, it can go to 3, it can go to 4. If there are 4 buys to every 1 sell, the buy to sell ratio would be 4. But when the buy to sell ratio gets to 0.20, which is essentially 5 sells to every 1 buy, we say that the market is extremely oversold. So when those indicators get to those levels, we're kind of excited, believe it or not. We are ready for a rally. We know that upside potential outweighs downside risk. We know the rally is likely going to be sharp and explosive. So we kind of get excited when those indicators get to those levels, because we know that once we wait for the rally and we wait for the rally, we don't just buy when the MTI goes below 0.6 and the buy to sell ratio goes below 0.2. We don't buy yet. We buy when there's a rally. And the rally occurred the day after Christmas. Big unfilled green candle here. The VectorVest composite formed a one white soldier. That's a bullish candlestick reversal pattern. Followed through the next day, and we were off and running. Okay, so you have to understand what the market can do. Look, we'd all love for it to trend, right? Higher highs and higher lows forever. Doesn't work that way. It can it can move sideways. It can channel like it did in 2018, or it can hit extremely oversold situations. So recognizing what the market's doing is very important. Now that you understand that better, the next piece is which indicator is ideally suited for that market environment. So if I'm in a trending market, we know what a trending market looks like. I'm going to talk to you guys about the MACD. MACD stands for Moving Average Convergence Divergence. The first 2 words in that indicator, in that acronym, is moving averages. Moving average. Moving averages are trend indicators. They identify changes in trend. So it would just make sense, right? If you're in a trending market, let's use a trending indicator. So we're going to focus on how to use the MACD in an uptrend in a trending market. If the market's no longer trending, and you know how to recognize that now, if the market doesn't hit higher highs anymore, but it also doesn't hit lower lows, right? So you have that sideways channeling market. We're going to use support and resistance. I'm going to show you guys how to use support and resistance to buy and sell, to short and cover positions in that type of market. And then finally, if the market hits an extremely oversold situation, we're going to use stochastics. I'm going to show you folks about how to use stochastics to kind of pinpoint entries and exits. So MACD is a really simple indicator, right? Here we're looking at Netflix. I got the MACD at the bottom of the chart. Really simple application is when you see the histogram bars, that's these yellow bars, go from below 0 to above 0, that's a buy signal. From above 0 to below 0, that's a sell signal. Okay? Very simple, but the mistake that traders make when trying to use this indicator is they use it in a sideways, non-trending market. If you know anything about moving averages and have tried to use moving averages before in a sideways market, you know that they fail you. Okay? You know that they fail you. Moving averages don't work well, okay, in a sideways market. MACD doesn't work well in a sideways market. So we're going to focus on using a trend-based indicator, the MACD, identify meaningful changes in trend in a trending market. And just take a look. You look at any chart. Netflix is a good example, right? Because it's a nice trending stock. It's not, and I'll show you in a moment, when it stops trending, what happens to the effectiveness of the signal. But we can see, did you have an opportunity to make money here? You had a buy signal. Did you have an opportunity to make money? Yes. What about here? Yes. What about here? Yes. Nice up. You're in a nice uptrend, right? What's happening is higher highs and higher lows. What about here? I don't know. Maybe we walked away even here, right? You didn't have a strong opportunity to make any money. Price didn't appreciate all that much from your buy signal. In fact, the sell signal came in right in this area here, which probably would have caused you to close the trade at a small little loss, maybe a wash. But you got a chance to get back in. Another chance to get back in. Remember, MACD identifies meaningful changes in trend. We are weeks off of this higher swing low here. Okay? We are weeks off of the higher low. I'm going to talk in a second about other indicators to use to get in a little earlier, but we're talking about trend changes. Here we had another buy signal, but again, sell signal came in about a week or so later. Maybe you walked away with a small little loss. Okay? What I'm seeing, though, is more winning trades than losing trades. I'm seeing more winning opportunities than losing opportunities. The losing opportunities as well, the losing trades aren't catastrophic losses either, right? They're small little losses. You're following the signal. You're in an uptrending environment. You buy when you have a bullish crossover. You sell when you have a bearish crossover. The examples that I've shown you here for Netflix have resulted in more winning trades than losing trades, really nice winners as well, and the losing trades that we've seen are small. Sometimes maybe a wash, maybe a small little loss. Now, as you can see, the environment of Netflix is changing, right? It's no longer trending. Let's take a look now at the effectiveness of the indicator going long on bullish MACD crossovers. Did we make any money here on this bullish MACD crossover? No way. Right? Bearish crossover happened about a week later, winded up with a loss. Did we make any money here on this bullish MACD crossover? No way. Right? A bearish crossover came out here, loss. Now, don't use the MACD to go long in a downtrend. Now, we're in a downtrend here. Netflix is clearly in a downtrend. How do I know that? Lower highs and lower lows. You can go short on the bearish MACD crossovers and cover on the bullish MACD crossovers. So it's important to recognize, you may say, well, this bullish MACD crossover here was the big one, right? That was the big one. But why would you want to do that? Why would you want to get lucky, I guess? You're always trying to catch the big one. You try to catch the big one here. You think that's going to be the one, right? Well, it wasn't. You think that's going to be the one. Well, it wasn't. You keep trying over and over again. You'll eventually get it, but you're going to wind up with a loser after loser after loser, having to dig your way out of a hole. And you may look at that big run there and it's good, but you've just reduced your buying power so much where it's going to take you even longer or even a much bigger move to recoup those losses. Okay, so we don't want to use the MACD to go long in a downtrending market, especially we don't want to use the MACD to try to catch a bottom. We'll use other indicators for that. Okay? All right. Next indicator we'll talk about, let me move this over, is support and resistance. Let me recap. Apply the MACD to uptrending stocks in an uptrending market. I'm going to leave it there. Okay, apply the MACD to uptrending stocks in an uptrending market. When the market no longer trends higher, right? It's kind of doing what you're seeing here, or what we saw on one of those previous VectorVest composite charts where it's moving back and forth, 2018, right? We're going to talk about support and resistance. Another very popular trading technique is to use support and resistance levels. One of the great things about the VectorVest tool is it has a way to automatically draw the support and resistance lines for you. Let's take a look at what I'm talking about. Before we get too deep, what is support and resistance? Basically, a support level is a point where stock prices have stopped going down and they begin to go back up. They stop going down, they begin to go back up. Typically, that happens on multiple occasions. Support is where demand is deemed strong enough to push the price higher, to support it from falling any further. Resistance is a point where stock prices have stopped going up and they begin to come back down. Again, that typically happens on multiple occasions. Resistance is where supply is deemed strong enough to push the price lower, to resist it from rising any further. Okay? It is the ultimate crowd mentality indicator. Think about it this way. Have you ever bought a stock, you watched it go up, right? You watched it go up, but you didn't sell it. Why didn't you sell it? Because you thought it was going to continue to go up. Then what happens? It comes crashing back down. And what do you say to yourself? You say, excuse me. Well, you say, if it ever gets back up there again, I should have sold it up here. But if it ever gets back up there again, I'm going to sell it. Then what happens? Price eventually gets back up to that level. You and everybody else that didn't sell it the first time sell it, and that puts tremendous pressure on the stock's price, and it's going to begin to fall. So how do you use support and resistance in your trading? Number one, we'll talk about the buying opportunities. So buying opportunity number one is if you see price hitting support and bouncing off of it. Hitting support, bouncing off of it. Hitting support, bouncing off of it. That's a buying opportunity. Price bounces off support, that's a buying opportunity. The other buying opportunity is when price breaks out through resistance. Remember, we already said that there was built-in selling pressure, right, around those resistance levels based on the crowd mentality. So if a stock is able to overcome that selling pressure and bust through that resistance level, that's very bullish. And that's another buying opportunity. You can also use support and resistance to indicate when to sell an existing position, an existing long position, or to initiate a short position. So if you see price hitting resistance and moving back down, that's bearish. All right? That's bearish. If you're long the trade, should consider selling it. If you're not long the trade, you could consider opening up a short position. So price retracing from resistance is bearish. Price breaking down through support is also bearish. If you're long a trade and price breaks down through support, you should consider selling it. If you're not long the trade and price breaks down through support, you could consider opening up or initiating a short position. Think about what would happen to the MACD in this type of a market, right? In this type of a stock environment. You can imagine that you're not going to be very successful using the MACD in this type of a market. Okay? And then the last indicator we'll talk about is stochastics. So let me recap the prior segment there. If you don't see the market trending and you see it moving sideways and channeling and bouncing off of support, go look for stocks that are also bouncing off of support. If you see the market maybe approaching resistance and then breaking out through resistance, maybe the market has retraced from resistance 2 or 3 times in the past, right, in the recent past, and then finally breaks out through resistance, go look for stocks that are breaking the resistance, breaking their own resistance levels. And I'll show you how you can easily scan for those in a moment. So here we'll look at stochastics. As with other oscillators, stochastics helps pinpoint overbought and oversold conditions. Don't let all these squiggly lines confuse you. It's not confusing. We'll just take a closer look at an example here. If you want to know anything, guys, about MACD or stochastics, right, how they're calculated, the formula and all that, you can go ahead and Google it. I'm not going to talk about that here today. My job is to show you how to use the indicator and not dissect it and talk about how it's calculated. Stochastics is an oscillator. It oscillates between 0 and 100. Below 20 is considered oversold. Above 80 is considered overbought. We're only going to talk about the oversold situations today and the buying opportunities. Would you agree that when stochastics is somewhere, below 20, you're somewhere near a good buying point, right? Somewhere near a good buying point. Yeah, right? And here we're in an uptrend. And this is where I told you guys that you can mix and match indicators. You can use stochastics really, guys, in any market. But you can't use the MACD in any market. I would really only focus on using the MACD in a trending market. And then you can kind of mix and match using stochastics in really any type of market. Because you can see, even in a trending environment like Abbott Labs was back in 2017, 2018, the oversold stochastics gave us good buying opportunities for short-term gains. Now, a buying opportunity occurs when the stochastics oscillator moves from below 20 to above 20, not just when it goes below 20. And you could see that gives us really good buying opportunities. Right? Stochastics goes from below 20 to above 20, not just when it goes below 20, because the stock can continue to fall. Stochastics goes from below 20 to above 20. I'm going to talk about managing the trade here in a moment. But I just want to give you an idea on, in a nice uptrending market like we're in, and you may not think, you may look at price right here, right, this little pullback here, and you may say that this can't be oversold. That's not an oversold situation. But stochastics is telling us that it is, right? So price, just looking at price is very deceiving. That's what indicators are for. It's hard for us with the naked eye to really make complete sense of price action alone without using indicators. That's what indicators are for. So you may look at these pullbacks here, this one or this one here, and say that's not oversold, but stochastics is telling us that it is. Okay, so here's an example. Let's talk about kind of trade management and just kind of combine a few of the things that we've talked about so far. February 2018, you got a buying opportunity. Stochastics crossing from below 20 to above 20. A few days before that, you had a bullish harami. That's a bullish candlestick reversal pattern. Follow through the next day. Stochastics crossing from below 20 to above 20. Good buying opportunity there. Okay? What I would be concerned about is the most recent swing high here. Why would I be concerned about the most recent swing high? Do you guys see those long upper wicks on those candlesticks? That's not bullish, by the way, right? That's bearish. That's a bearish indication. That's an indication of a weakening uptrend when you see long upper wicks at the tail end of an uptrend. Why is that bearish? Because sellers are able to close the stock closer to the lows of the session on those days, well off of the highs. Right? So that's not a bullish situation. That's not bullish price action. That's bearish price action. So that same level, if I enter a trade and I'm approaching a level of recent weakness, that level is going to be where I look to take gains off the table, maybe tighten up my stops at the very least. We're lucky enough with this one here that we got to that level. Unfortunately, we didn't break through that level. If I'm in the trade, look, I'm hoping and I'm waiting for it to break through that level. If it doesn't and it retraces from it, you take your gain off. Okay? When price fails to make a new high, right, and pulls down, what is being established at that level there? What's being established? That's resistance, right? We talked about resistance a few minutes ago. That's resistance. Price falls. We're going to get another opportunity. Look at stochastics, how it goes below 20, crosses above 20, giving us a nice opportunity to buy again. So price fell to the same, essentially the same level that it fell back here, right? Right about the same level. It doesn't have to be the exact price point. But what is this? What are we now establishing here? We're now establishing a support level. Price retraces. You got a little bit of a pop there the next day. You enter the trade only to see what? Only to see the stock crash the following day. It's a pretty big down day for a stock like this. You say, uh-oh, what do I do? Well, if you're recognizing that price fell and stopped falling at the same level that it stopped falling back here, what is that? What are we establishing here? We're establishing support. So with price falling the day after you enter the trade, what are you watching for? What are you keeping an eye out for? You're keeping an eye out for price falling through that support level. But it doesn't, does it? Right? It stops right at it. And then retraces from it. And that retracement there, you think, all right, I'm in the clear. All right, I didn't panic sell like I might have done in the past. I understood that there's a support level here that's going to protect me against future losses, so I'm going to hang in there. If price doesn't break down through that support level, I'll stay in the trade. It doesn't, you think you're in the clear, only to see another retest of that support level. So price comes back down. You're saying, all right, I'm going to hang in there again. I know that there's a pretty solid floor here that's going to protect me. If price breaks down through that floor, I know that that's bearish, and that Jerry said that should be an indication to sell a long position. Well, price stops again at that very same level. That's a hammer there, that long lower wick. Remember I told you about the long upper wicks at the end of an uptrend, how that's bearish? Long lower wicks at the end of a downtrend is bullish, especially at support. You got a nice retracement off of that support level, and you hung in there a few times, knowing that you had a nice protection there in support so that you realized a winning trade. That resistance level, by the way, doesn't go away, right? So that resistance level, where we have two touches here, doesn't go away. It stays there. It's a level that we need to watch out for. Price reaches that level again and then retraces from it. That's bearish. That's an indication to close your position. And you could have closed it, guys, along the way, okay? But if you're waiting for it, the price to reach resistance and then finally does and retraces from it, that's where you kind of take the whole position off. If you took half off along the way, you see that big retracement off of resistance, you take the rest off the table. We can get back in. Okay, we can get back in. Stochastics goes from below 20 to above 20. We enter back in. We still have that resistance level. You see that big red candle there? That is a resistance retracement, and I would exit the trade at that point. Even though I know what the stock price did after that, right? I'm following the rules here. Price retraces from resistance. I exit the trade, only to see it break out through resistance a few days later. Once price breaks out through resistance, that resistance level becomes support. A lot of times what you'll see is price come back down pretty quickly to retest that support level, which it did here. It retraced from it, came back down, retested again. That retest of support coincided with stochastics going from below 20 to above 20, and there's your other opportunity for another trade there. Okay? So stochastics is a really good indicator. Now, once we get into this situation, now we're back into a sideways market now. Right? So it makes things a little difficult, but just using support and resistance along with stochastics crossovers will help you manage trades. For example, and I just kind of went through it, stochastics crossing from below 20 to above 20 is a buy signal. When you're in the trade, price retracing from resistance is a sell signal. So you can mix and match and couple support and resistance and stochastics to help you pinpoint both entries and exits. All right. The last piece of the puzzle is, how am I going to find my trades? I hope that you guys are better equipped now in number one, identifying what the market's doing. Once you do that, you have 3 indicators to use, one for each of the 3 market situations that you will encounter. Now we'll talk about, how am I going to find trades? There is we call it the 1-by-1 method. This is where you look at chart after chart after chart. So if you're in a trending market, right, you know that we're going to use the MACD. So what you would do is you would look at charts, and you'd look for a bullish MACD crossover as of the current time, as of the current date. Not a week ago. I don't want to find a bullish MACD crossover a week ago, and even though the MACD is in bullish territory today, it first crossed bullish a week ago. I don't want to find that. I want to find the crossover within the last day or two, right? So you'd go through the charts, and you'd go through the charts, and you'd go through the charts one by one by one. Maybe you find some, maybe you don't, but it takes a lot of time. This is kind of my preferred method, actually, by using a search or a scan to help at least narrow down your field of candidates. Okay? I like looking at charts, and I think it's important to do that. But the scan will help you get most of the way there. It's going to find the crossovers, right? And I'll show you in a second exactly what I mean. And then there's automatic alerts. Automatic alerts is just that. It gives you real-time alerts intraday to your cell phone or to your email, or both, when crossovers occur. And we have tools to do that. So the 1-by-1 method, for example, I look at the S&P 500. There's 500 stocks in this list. I want to look for stocks whose price is retracing from support today. I'd go through all the charts. I want to look for stocks whose stochastics is first crossing from below 20 to above 20 today. I'd look at all the charts. And I'm not going to do that only because it just takes a lot of time. Sometimes you don't find any. Okay? My preferred method is using a search. And within the VectorVest real-time program, we have a tool called ProTrader. ProTrader is a technical analysis scanning tool. It scans for MACD crossovers, both long and short. If you're in an uptrending market, you look for bullish MACD crossovers. If you're in a downtrending market, you look for bearish MACD crossovers. It looks for stochastics. Stochastics crossing above 20 gives you that buy signal. It also looks for all 4 of the situations using support and resistance that we talked about. Price retracing from support, price retracing from resistance, price breaking support or price breaking resistance, all depending on what the market's doing. So if the market is retracing from resistance and you want to go find stocks to short, you would scan the VectorVest database for stocks that are retracing from their own resistance levels. Then I'd go into the charts and I'd kind of pick out really the stronger retracements. I'm not going to just go out and buy the top 10 stocks. I'm going to look at the charts. So again, it gets me most of the way there. Finally, the automatic alert tool that we have is called the Watchdog. And I have a few watchdogs running all the time. You know, we've been in an uptrending market, right? So I have, as you can see, it's a MACD bullish crossover on S&P 500 stocks that are above $5 that have an average volume greater than 250,000 shares. I set that up here. In real time, you can see a couple of alerts I got. Now, today was a down day in the market, so I got a couple of alerts right out of the gate. Today's 529, right? Yeah, Humana, Hormel, CHD, right out of the gate. Right as soon as the market opened, I got a couple of bullish MACD alerts today. Okay? But because the market was down today, I'm not looking at trade long. Okay? Got to have follow through. If the market was up today and I got some bullish MACD crossovers, I could have looked to trade it at some of these. I look at the charts from here as well. I just wouldn't blindly buy Humana or Hormel just because they had a bullish MACD crossover right out of the gate. First off, I'd wait at least 15 more minutes to a half hour until about 10 o'clock to see how things shake out right out of the gate. Okay? All right, you guys showed up today. I'm going to take a few guesses. You feel like, I hope you guys aren't missing out on this current market. We're leaving the buying opportunity of a lifetime. Look, we have still a lot of upside to go, right? We're still about 15%. The VectorVest composite is still about a good 10-15% away from its all-time high, but we are a good 30+% off of the bottom. So I hope you're not missing out on the current market. I hope you guys have been taking advantage of the rallies. I really have. But if you're feeling like you're missing out on the current market, maybe your trading plan that you're using isn't performing like you want it to, or you just showed up today because you want a better, faster way to find trades. So what did we learn today? You learned to match the market to your indicator. Or, in other words, match the indicator to the market, because the market is what we have to recognize first. What is the market doing? Which indicators is ideally suited for that market situation? And then how am I going to go out and find my trades? I taught you how to effectively use popular technical indicators, and then how to quickly and easily find trading opportunities. And the big lesson is that technical analysis can help anticipate future direction, and you can find some great trading opportunities, especially if you use the power of speed. Okay? So, you might be asking, this has been really good stuff. Kind of a novel approach. What's the market doing? It can do one of three things. Here are some indicators to use in those different types of markets. So you might be asking, how can I get started using these indicators now? You got a choice. You can do it the slow way, which is just maybe take bits and pieces of what I've taught you here today, really doing it the one-by-one method, or you could do it the fast way. So the one-by-one method is you look at charts. You look at MACD crossovers if you're in a trending market, support retracements if the market's retracing off support, stochastics crossovers if in any type of market, really. But you look at the charts one by one by one. The faster way is by using those pro trader scans, right, where you can just simply easily scan for MACD crossovers or support and resistance crossovers. And then finally, within the real-time program, we also have a tool called the Watchdog. This is instant alerts. You set it up once. You don't even have to click a few buttons every day. You set it up once, and it will send you alerts every day moving forward because it automatically scans the market for you. So, as a recap, within our VectorVest real-time program, it comes with fundamental and technical charting, market timing signals for clear entries, pro trader scans, the Watchdog, which gives you instant alerts, the Genius, a tool that we have called the Genius, which is an automated portfolio manager, gives you alerts as well. Of course, pre-built trading systems, and of course, real-time streaming data. Now, normally we would sell this, and we do sell this, for $137 per month. What I want to do is I want to give you guys an opportunity to try it out for $9.95 for 30 days. This is a special offer. And what I'm going to ask Ray, and he's already done it, awesome, is to type that address. You see that address that you guys see at the bottom of your screen, vectorvest.com/capture-trades. Ray has typed it in the chat box, so you can just simply click on it. If you don't have real time, okay, if you don't have VectorVest real time, we're going to give you this special offer, $9.95 for 30 days. It comes included with everything that I've talked about. If you order the real-time program before the end of today's webinar, this is not. This is given to everybody who orders, not only today, but up until Tuesday when this special expires. I'm going to give you guys a stock buying checklist. This is really good for those of you who like to be a little bit more hands-on with your trades, right? Because it makes sure that you follow all the rules that we discussed today. Okay? By the way, this is also a 30-day money-back guarantee. You try it out, $9.95, for 30 days. At the end of 30 days, you say, you know what, I'd rather go back to my end of day subscription, VectorVest end of day, or my intraday subscription. Or if you just want to cancel, we'll give you your $9.95 back. Okay, but this special offer, guys, is only good until Tuesday of next week. And what I am going to do now, thank you, Michael, for reminding me, I am going to insert the PDF of today's slides in the chat box, in the handout section of your GoToMeeting control panel. Okay? The GoToMeeting control panel handout section. You guys should see it. It's there now. Okay? All right, guys. Any questions at all before I close up shop here today? Any questions at all? Oh, by the way, after the 30 days, it will automatically convert into a monthly subscription for $137 per month, and that's for VectorVest 7 real-time, the U.S. product. Okay, if you're interested in any of the other markets, just kind of let us know. But this is for the U.S. market. But VectorVest.com/capture-trades, $9.95 for 30 days. If you already have real-time and you want that checklist, just shoot me an email. My email address is jerryd, Jerry, D as in David, @VectorVest.com. Just shoot me an email, and I'll send you that checklist. Just say, hey, Jerry, I'm already a real-time subscriber. Can you send me the checklist? I'll check to make sure that you're a real-time subscriber, and I'll go ahead and send you that checklist. But if you're not a real-time subscriber, if you have our end-of-day program or intraday program, it's a no-brainer in my opinion, only for $9.95. You get to try it out for 30 days. It comes included with everything that we talked about today. And it's just going to make your lives a lot easier so that you don't have to look at charts. If you're a trader and you don't have a scanning tool, you're just spending too much time looking for trades. Remember, one of the first things that I said earlier is one of the main things I wanted you guys to take away from today is speed is the key. The speed in which you find your trades and react. Okay? It can be done the other way. Who wants to do it, though, that way? Who wants to spend all day looking at charts, possibly maybe not to find any? All right, guys. Yes, this session is being recorded. You guys should get the recording in a few hours from now. We'll get it out to you this afternoon. Okay? Any other questions, guys, before I end today's session? I want to thank Ray for being here. Ray did a great job answering your guys' questions. And it is Friday, right? So I want to wish everybody a happy Friday. You're welcome. Urian, you're welcome. I want to wish everybody happy Friday. You're welcome, Kingsley. Enjoy your weekend, guys, and we will see everybody again real soon. Take care, folks. Have a great day.